All right. Good Thursday afternoon, traders, investors, Phenom Group members, and our YouTube audience. Going through a bit of a swoon in the markets. We are here on Thursday. Of course, if it's a state of the market day, it wouldn't be a state of the market day if the market wasn't red, right? But got to stay optimistic. What we're seeing this week here is basically revisiting last week's S&P 500 low levels. Last week, S&P 500 dropped all the way down to 43.05. Today, Thursday, we got down to 43.15. Nasdaq broke below, briefly intraday, below its 100-day moving average. Both the S&P, well, all three, S&P 500, Nasdaq, and Dow Jones below their 50-day moving averages, and it looks like it's going to be that way here for 2 consecutive weeks, which is not something we've seen pretty much all year long, shy of the Nasdaq, which did have a 12% correction earlier this year. And the main reason I bring this point up is in order for us to be below the 50-day moving average on the major indices for 2 consecutive weeks, that tells us they're not buying the dip the same way that they had been throughout the course of this year. There's a bit of a behavioral change here in the market. We can chalk it up to various different things. We can run down a laundry list of headwinds that the market faces, none or the least of which is, of course, the September seasonal headwind that seems to always confront the market. It is month end, it's quarter end, we have outflows, we got rebalancing. September's just a bad month for the market, and it looks like this is going to be an extra bad month. We're going to wind up being down around 4% here on the S&P 500 for the month of September. It also looks like, barring any miraculous feat of strength, we're going to end the 7-month win streak in the S&P 500. Keep in mind that we've been up every month since February. So if we're not up this month, and it looks like that will be the case, not being up this month, we're going to end that winning streak. But all good things have to come to an end, right? In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. That's from Peter Lynch, basically saying, 60-40. As long as you're right 60% of the time on an equal weighted portfolio, you're going to come out a winner by the end of the year. So do keep that in mind. One of the issues that is impacting the market and creating the conditions that we talked about in previous State of the Markets for a bigger drawdown in the major indices is the fact that coming after the growth stocks, coming after tech, coming after the mega cap names in the market, creating those conditions for a bigger drawdown. Now, one of the latest reasons that they're coming after tech, coming after growth, I prefer to think of it as growth, even though tech and growth are pretty synonymous in the market, is that yields are rising, right? And we've all heard the colloquialism that long duration instruments, which technology is classified as, tech stocks are classified as long duration instruments, they get hit when rates are rising, when yields are rising. And it's true, but it needs more. We need to flesh it out a little bit more. So this chart right here, S&P 500, large cap tech correlations with the 20-year treasury yields. And as you can see, most of the time, here's the zero line, meaning anything below zero. If the lines are below zero, there's no correlation, or there's a negative correlation. Now, when we get above zero on the S&P 500 large cap tech correlations ratio with the 20-year treasuries, when we get above zero, that means they're positively correlated. Yields are going up, tech stocks are going down. There's a positive correlation when it happens rapidly. This spike here, as you can see, it's a spike in yields. Tech stocks, they follow. It gets a positive correlation. So it's not that tech is core. It's not that all the time when yields go up and when rates go up, tech goes down, the Qs go down, growth stocks go down. It's not the case. It's a matter of them rising too quickly. This chart right here shows you the rolling 1 month S&P 500 return Z-score of 1 month change in 10-year treasury yields. So if we look down here, rates are falling, rates are rising on this side. So we look down here in the chart, nominal rate yield change magnitude is noted along this x-axis here. As we can see, when yields are rising 2+ standard deviations, so greater than 2 standard deviations, the 1 month S&P 500 return is largely negative. So, I mean, if the S&P 500 is struggling, it's because we're getting a rapid spike in yields or rates, and the S&P 500's most heavily weighted sector is obviously tech being growth being tech. So naturally, we would assume in a rapidly rising yield or rate environment, the S&P 500 is going to struggle. And again, the reason why we go through these exercises and dissecting what's going on in the market and why it's happening is to rationalize, is it normal? So is the rapid rise in rates commensurate with the S&P 500 struggling? And the data suggests yes. In all absolutivity, it is. So what we're seeing in the major averages, and back down to last week's low is kind of supposed to happen. We're coming off of a Fed meeting where they advanced the dot plots, the dots in the dot plot forward, meaning that they're moving their rate hike potential more near term. Now, when I look at Fed fund futures, we're still not seeing the probability for a rate hike until December of 2022. But you couple that with a more hawkish Fed and, basically without saying they're going to announce tapering, they said they're going to announce tapering come the November meeting. But things can change between now and then. I bring that up, and I think investors should remain flexible and open to the idea that even that forecast for announcing their tapering plans at the November meeting, and keeping in mind there is no October meeting, still is dependent upon achieving further substantial progress in the labor market. And we're not seeing that. We're not seeing further substantial progress. We've had 2 straight months of non-farm payroll report under 500,000 jobs being created, under 300,000 jobs being created last month. We've now had 3 straight weeks of jobless claims rising. Something's not right. It wouldn't be prudent for the Fed to announce, let alone start tapering plans without further substantial progress on that employment mandate. Otherwise, their credibility is shot. They're data dependent. We need to see further substantial progress. That's what they've been saying for months on end. And yet, 3 straight weeks of jobless claims rising and non-farm payrolls less than 500 for 2 straight months. The fact that we've had 3 straight weeks of jobless claims rising tells you next week's non-farm payroll report for the month of September is probably not going to be that strong. The Fed really is going to be challenged to announce tapering, let alone start the process without improvement in the labor market. So while everybody's on edge and yields are rising rapidly from 1.3 on the 10-year yield, 1.3%, up above 1.5% yesterday, 20 basis points in less than a week, the fact is that something's not quite working in favor of the Fed's dual mandate. The inflation mandate, well in hand. The employment mandate, don't be shocked if they are forced to backpedal. Now, can they still do tapering? Yes. The optimal approach for the Fed, assuming that we don't have a further progress on the non-farm payroll report when it's released next Friday, is to do an operation twist. They can still taper. One of the biggest challenges to the Fed at this point, in seeing how strong the housing industry is and how much home price appreciation we've seen, basically pricing out first-time buyers, millennial buyers, is that they need to stop buying mortgage-backed securities. They can do that, or they can taper the purchases of mortgage-backed securities and simply increase the Treasury securities that they're purchasing. So rates can still gradually go higher, but they're still providing the same amount of liquidity, the dollar liquidity, into the financial system. Operation twist of sorts, which is what they did back in the after the great financial crisis, 2015 or 2016, Operation Twist. That would be the ideal approach for the Fed. Again, assuming that we don't make further substantial progress on the employment front. All right. So with that, rates rising rapidly, yields rising rapidly, and we do see the S&P 500 struggle. Greater than 2 standard deviation move, which is what we've seen here in a week for the 10-year yield, and the S&P 500 is having problems. We can also see that here in this data. The middle chart is the 10-year yield. TNX is the ticker symbol for the 10-year yield. This is at the bottom panel, the S&P 500 growth versus value, right? So yields rising quickly, growth, tech having a struggle, and the flight to value is financials, banks. What does well when yields are rising? Financials and banks. And those are largely in the value area of the S&P 500. So while many will lay claim to rising rates and yields impacting tech the hardest, the fact is that growth as a whole is mostly impacted, in tech, of course, is a large part of the growth area of the market. Growth stocks have often seen some short-term struggle when the 10-year yield rose 15% above its 50-day moving average. So the middle panel here is the 10-year yield. There's the 50-day moving average, 15% above it, which is basically where we're at right now. And you can see we've been there several times since 2020, and growth tends to struggle. You see these hiccups here. Here's a time where we got above it, and see market has a problem. Why? Again, the market is tech growth. If that's having a problem, the market's going to have a problem. There's another time we got above the 15% threshold in the S&P 500 here, and indeed, the market dipped. Struggle. Here again, here again. You can see the dips in the S&P 500 growth versus value ratio. So it's these rapid rises. It's not whether or not the 10-year yield is rising that affects growth, that affects tech. It's how quickly it's rising. Here's the most recent chart as of yesterday's close on the value versus growth ratio. S&P 500 value relative to S&P 500 growth. And you can see value has outpaced growth here. Late in September, massive spike. We've seen the Nasdaq get killed, go down below its 100-day moving average here today. We've seen FanMag names, Apple, Microsoft, Facebook, all of them, Google, Amazon, all come under pressure. Growth. While the banks, while the value components of the market have kind of taken that baton of leadership once again. This is going to be very short-lived, folks. We've got some issues that the market is trying to grapple with right now, which is keeping a lid on further progress. As I said before, usually we get bought and we're back to all-time highs. That has not happened here in September. That coupled with rising rates, we've got a lot of headwinds, a lot of issues the market's trying to contend with at the moment. Some of you might remember this chart here. Back in March, right? We went through the same thing back in March earlier this year, where the Nasdaq was doing this, where growth stocks were doing this, where tech was doing this, and yet the rest of the market was going this way. The reflation trade, the cyclicals were all going higher, and everybody was blaming it on rates, blaming it on the yields going from 1.2% at the beginning of the year all the way up to 1.7+% on the 10-year yield. So here what we're looking at, we got the 10-year treasury yield at the bottom panel, and the top panel, we have the Qs, the equal weight Qs, the Nasdaq 100, equal weight Nasdaq 100. And you can see yields going down, Nasdaq going up, or the Qs going up, rates going up, yields going up, Nasdaq still going up, the Qs are still going up. Yields going back down, 10-year yield going back down, Qs are still going up. This pivot point here, yields are rising from 2016 through 2018. The Qs are still going up. There's no real correlation long term, is basically what's identified in this comparison of yields at the bottom and the Nasdaq 100 at the top. The Nasdaq 100 goes up over time regardless of what yields are doing in this choppy up and down pattern. So this is kind of looking at it over several years from 2012 to 2020. It doesn't matter. Like when the earnings are there, and that's where they are. Earnings are there. That's why they call it growth, because they have the highest rate of earnings growth. Tech growth. The Nasdaq is tech growth heavy. The Nasdaq itself is a growth index. Its greatest composition is technology and healthcare, the two largest growth areas of the market. So this disavows, if you will, the whole notion of, well, tech comes under pressure because it's a long duration asset, and so when yields are right, no. That's just garbage from the media. It really is. You can click on the link here and it'll take you right to our research report back in March when we outlined this. And we determined that the weakness we saw in growth, the weakness we saw in tech, in Apple, in Facebook, in Google, in Amazon was a buying opportunity. And lo and behold, within 30, 60 days, all of those stocks were achieving either new all-time highs or, back in an uptrend. So when we talk about market breadth and how the conditions have ripened, wholly admit that the conditions have ripened for a bigger drawdown. As investors, in order to keep your investor psychology, your trading regimen true and consistent, and delivering those repeatable returns over time, you have to have an appropriate expectation of the market. When the market is showing that there's internal stress, breadth is weakening, you simply have to have an appropriate outlook to manage through that time period where you could see a bigger drawdown in the market. This is the Nasdaq 100% of new 21-day lows. Why 21 days? Because 21 days is basically a calendar month, a trading month. Percentage of new 63-day lows is basically 3 months. And you can see the new lows are rising. That's not a good sign. That's not a good sign. It means there are more stocks making new highs on a 30 calendar day basis and on a 3-month basis. So once they hit those large cap stocks within the index, then you've got a problem because you have weak internals, and really the only thing holding up the index is those large or mega cap names. This is the Nasdaq Composite, the percent of stocks down 10% or more from 52-week highs. And it's been trending higher, for a while now. 66% of stocks are down 10% or more for their 52-week highs, which tells you most stocks in the Nasdaq have been in a correction. Percent of stocks down 20%, which is a bear market from their 52-week highs, is almost 50% of the Nasdaq has been in a bear market here this year. A correction has long since been taking place underneath the surface of the Nasdaq. In a similar way, it's been taking place underneath the surface of the S&P 500. About 85, almost 90% of S&P 500 stocks have already had a 10% drawdown year to date. This is the S&P 500 in yellow. Its biggest drawdown was 4.2%. But the blue is the percentage of stocks that have had a 10% drawdown or greater this year. It's all the way almost up to 90% of stocks. Both indexes have already had a correction taking place underneath the hood. It's only when you go after those mega cap and large cap names, though, the market struggles. And so you've had this internal conflict in the market, and then you get a rapid rise in rates, which impacts those large cap growth tech names, and it's the perfect recipe or perfect storm, if you will, not to mention the month of September, where you could get a bigger drawdown. Here's the Nasdaq percent of stocks above their 200-day moving average, down to 58%, which, as you can see, is the lowest level of the year. There's still, the majority of stocks are still above their long-term moving average. Still a bull market, still healthy in that sense, but obviously has weakened a great deal. Nasdaq 100 stocks above their 50-day moving average, only 24%. It's not as bad as it was in March. And more than likely, this is going to prove a buying opportunity. Given that the index is not even down 10%, this may just be the beginning of a bigger drawdown. Hence, remain cautiously optimistic, flexible with your game plan, and that flexibility needs to center on position size. This is not a don't buy the dip moment, in my opinion. Although the headwinds are robust and we need time for things to play out, in the pre-earnings season is proven rather, you could say, ominous. I mean, we're not seeing good results. And a lot of the reason is because of the supply line issues. It's because of wage inflation. It's because of a worker shortage. These issues will be smoothed out over time and find resolution. But in between now and then, the market is going to discount that kind of potential weakness in earnings going forward. We're still going to see earnings growth, folks. Don't get me wrong. And we're probably going to beat estimates for the third quarter in the same way that we beat them in the first and second quarter. However, guidance. A lot of the companies, FedEx, Nike, this morning, Bed Bath & Beyond, huge miss. A lot of the companies are warning about, or they're lowering their guidance for the fourth quarter, and they're all citing either wage inflation, supply line issues that are resulting in inventory drawdowns. They can't replenish the shelves. Bed Bath & Beyond, retailers getting obliterated here today. Macy's with a Kohl's with a double downgrade to underperform today has dropped, I think, 15%. Macy's is down 10% today, and Bed Bath & Beyond was down 25% at its low point. It's taking down the whole of the retail sector. Consumer-facing companies who need the inventory just don't have it, or they don't feel that they have sufficient enough inventory to meet their sales objectives for the high holiday season ahead in the fourth quarter. So these are all the fundamentals that go with the technicals that suggest be flexible with your game plan. Look, the market understands the issues. It's not like, supply line is and wage inflation is something new this week. It's not. The market knows this. Again, to my point, You know, most stocks have been correcting for the, this year. They've been in correction or bear market territory. This chart right here, this is a good one from Ned Davis Research. It's also, yields in the S&P 500. If yields are rising along the yield curve, this is the yield curve chart at the bottom. This is the S&P 500 at the top. Yield curve is the 10-year minus the 2-year, right? That's the yield curve everybody talks about when they speak toward, is the yield curve inverted? Is it flattening? Is it steepening? We've been steepening the yield curve all week because yields are going higher. So you take the 10-year and you subtract the 2-year and you have your yield curve, or how many basis points spread between the two yields. If yields rising alongside the yield curve steepening proves a long-term buying opportunity for tech. It is proven by the level of the yield curve historically. The yield curve is near the upper end of bullish range for stocks. Gains are smaller when the yield curve is greater than 150 basis points. So let's go and see where we are right now. 10-year minus the 2-year, 10-year minus the 2-year treasury yields, and we have 125 basis points, 1.25, 125 basis points. As I said earlier, we're steepening the yield curve this week. Down here at 107 last week, we now have 125. We've been steepening the yield curve, but we're at a level now where it's still favorable. 0.0 to 1.5 on the yield curve. The average annual gain is 11% for the S&P 500. When you get above 1.5, the annual gain is 6.37%. And look at the percent of the time it's positive. Look at the percent of the time it's positive for the S&P 500. 60% of the time, double-digit gain annually. So it's good that you're steepening the yield curve, but you only want to steepen it so much. So just a heads up there. All right, information technology forward operating earnings. Why is it a buy the dip, as it says here, a buying opportunity for tech? Well, folks, look at what operating margins do for tech over time. I mean, they go up bigly over time, folks. The only reason why we were down in 2019 is mainly because the comps were so hard, to jump over in 2018 from the tax reform act going into place. Tech earnings grow over time. It's a buying opportunity on weakness. If you're not buying, I know other people who are buying tech, share buybacks. This chart shows the cumulative share buybacks by sector. Look at technology. It has the most buybacks of any sector. Why? Because they got the most free cash flow. Why? Because they got the greatest operating margin trend and the greatest earnings growth. You can afford to buy back the most shares. So if you're not buying, somebody else will, if not the companies themselves. Microsoft announced a $60 billion buyback this year. Right? There you go. Oh, but tech's too expensive, you say? Nay, nay. This was February 2000. Here's where we are now. But look, price to earnings was 60.7 back here in February of 2000. Now they're 35.6 times forward earnings. 44 forward price to earnings, it's 28 now. Dividend yield, basically non-existent back then, 0.6% now. Look at the profit margins, 19.7% today. Back in February of 2000, 12.1%. Valuations are extremely attractive today compared to the dot-com bubble era. As we kicked off this week's State of the Market, I had mentioned, concerns about the change in behavior here, amongst investors, right? They're not buying the dip as quickly, obviously. can go through a laundry list of reasons as to why, and I've already mentioned quite a few here that the market is grappling with. But one of the things that we talked about just last week is recognizing that we kind of broke this uptrend here, with this swing low here being lower than this swing low there. These are, the little things that you recognize, understand. There is something about investor behavior that has, I wouldn't say it's an incremental shift, but something's there. Something's there. Here's another chart from Thrasher Analytics, Andrew Thrasher, a friend of mine. The average stock drawdown bottomed in April. This is the average stock drawdown. In April of this year, it bottomed. Like I said, most stocks have been, drawing lower. That doesn't matter if you can't hit the mega cap names. But here's the other thing, as you can see, above is the chart showing the historical performance of the S&P 500 when the average stock drawdown is actually trending higher. And the market's going higher. It's entirely possible for the index to be rising in this type of environment, but history has shown it also brings within the potential for increased volatility. We got increased volatility here in September, and we're going into October, which is historically the most volatile month of the year. What we want to see is the average stock drawdown going this way, like it was doing here. I mean, you're still going to have hiccups along the way, folks. There's still going to be volatility, and volatility, as we know, is the price we pay for those expected returns. In the Phenom Group trading room with members, I had discussed the probability of the Nasdaq, because it was trading so close to its 100-day moving average, and it closed 2 days in a row below the lower Bollinger Band. More than likely there was going to be this pull down to the 100-day moving average. Sure enough, today we dropped just below the 100-day moving average. In fact, I tweeted out yesterday that there's probably going to be a buying opportunity, but 15 points or so below the 100-day moving average. Surely enough, we actually got to, I think, 20 points below the 100-day moving average on the Nasdaq today, and we had a pretty significant bounce. It's a tradable bounce. When I say tradable, it might be a bounce that you rebalance. Lighten up if you feel that the market is going to draw even lower. But as I've often said, your best opportunity is going to be buying before the bounce. Most of the time people get in trouble buying the bounce, because that bounce may be short-lived and roll back over and make a lower low, at least in the interim. There's a lot of headwinds for the market here. We're going into earnings season. You probably have seen this chart before from Deutsche Bank. Every single earnings season or ahead of earnings season, they throw this out there. The S&P 500 companies in blackout period basically travels the gamut of where we are this week here. And then at the height or the heart of earnings season is the height of the blackout period. The reality is, we did this study back in 2019. There's no such thing as a blackout period. It doesn't really exist. It's more of a common practice or a best practice on the part of companies to simply just wait to do additional buybacks after earnings season. But there is no rule saying you cannot buy company stock or make share repurchases during earnings season. There is no SEC rule that says that. All you have to do is have a plan. You have to have I think it's a 501B plan. These are all the rules, SEC regulations regarding buybacks. SEC established rules governing the conditions under which companies can buy back stock. This is the other section of the rules. Yeah, it's a 10B51 plan. As long as you have that, as long as the SEC has it on file for that company, let's say Apple wants to just do buybacks regardless of earnings season. As long as they have a 10b5-1 plan on file with the SEC, they can do it the day of, the day before, the day after earnings. It doesn't matter. But that is not what this Deutsche Bank chart would lead you to believe. Deutsche Bank is basically saying they're of the opinion that 10 days before a company reports, they can no longer repurchase shares. And that is just not true. Now, don't get me wrong. A lot of companies, they do live by that, meaning that they, 10 days out of their earnings release, they won't buy back shares, simply because they don't want any kind of appearance of impropriety. It's a best practice, but there's no rule. There's no SEC regulation saying you can't. Again, so long as you have your 10b5-1 plan. And here's the other thing. You can amend this plan whenever you want. Whenever you want. You just have to give the SEC the heads up. That's it. It's all basically on the honor system. But people always speak of the blackout period as being a headwind for the S&P 500 because there's no longer share repurchases being done. And now it's left on to the public in true demand, if you will. But that's not true either. There was this study here from Wes Gray of alphaarchitect.com. He performed a study on the effect of blackout periods on the market just 2 years ago. His findings were that they have almost no impact on the market. Blackout period has almost no impact on the market. Our results indicate we should reject the null hypothesis, as we have found no significant difference in returns in any of the periods measured of heavy buyback program firms, suggesting it is unlikely the buyback boogeyman strikes during blackout periods. This was taken directly from his study. He performed a study on the effect of blackout periods on the market last year. His findings were that they were no impact. So, why Deutsche Bank does this every single quarter? Well, frankly, people feed into it. They believe it. They don't do their research. They don't understand the rules regarding SEC buybacks and how companies, manage to stay within compliance, if you will. Okay. Just about every, large cap company that has come out in the pre-earnings season period for the third quarter has announced some type of issues regarding supply lines. And you see it littered all over the airway, whether it's Bloomberg or CNBC, talking about the issues, showing photographs of, just ships anchored offshore the Los Angeles port, the ships that are coming from China over to the United States with, boatloads and cartons of goods. This chart right here. Now, this is the most updated chart. Okay, these are the container ship rates coming from Shanghai to the Los Angeles ports. And you can see the orange is 2020, the blue is 2021. It's the same as last year. It's the same as last year, folks. The main issue is most people thought this would be cleared by now, and it's not. But it is getting better. 2 weeks in a row. This was last week and now this week. 2 weeks in a row, we actually see the number of containers, the container ship rates coming down. So I know the media is all hyperbolic, and the earnings that we're getting right now are, they're telling us that, they have low inventory. They don't have enough supply to meet demand. Therefore, their sales are going to be hurt. But we are seeing some improvement here. These two charts, total vessels of all types of container vessels, ships in Los Angeles and Long Beach. 148 total vessels in port right now, which is down. Look at that big drop right there. 92 total vessels at anchor and drift to seas. We see this probably plateauing and coming down. This one, okay, so this one was total vessels, all types of vessels. This is just the container ships in the Los Angeles and Long Beach port. And as you can see, pretty much the same thing. Peak here, 100 container ships in port on the 19th of September, and it's come down. Not by much. It's 97 right now, but it has come back down. 73 container ships at anchor or in a drift area as of the 19th, and that's come back down to 67. It's starting to get better. It's starting to get better, but we need to see more of a trend. But these are the reasons why I say cautiously optimistic. We don't know how long this is going to get right. I mean, these are, big upswings here. We're not going to go straight down. We're probably going to do this number all the way out into 2022. So this is a problem that's going to persist through the end of the year and at least through all of the first half of 2022. The companies right now that have the goods, that are, first in line, if you will, the Apples of the world, the Walmarts of the world, those are companies that can probably withstand, some of these issues of supply. But their guidance is what's going to drive the stock prices when they come out with earnings. Consumer goods facing companies right now being attacked in the market. Those are the ones that are getting hit the hardest because people are fearful of the shortage. You guys probably seen this guy. The infamous Rich Dad, Poor Dad author Robert Kiyosaki is out with his call. Giant stock market crash coming October. Why? Treasury and Fed short of T-bills. Gold, silver, Bitcoin may crash too. Cash best for picking up bargains after crash. Not selling gold, silver, Bitcoin, yet have lots of cash for life after stock market crash. Stock's dangerous. Careful. Con artist. This guy's one of the biggest con artists I've ever seen. It's just grotesque what he's done. He wrote the book, Rich Dad, Poor Dad, and he took advantage of an ignorant audience, in my opinion, benefited from the bankruptcy court system, but he has never once shown any audited results. Huge best-selling book, Rich Dad, Poor Dad. Nobody has ever seen this guy's audited results from any investments. Balance sheet, nothing. The Learning Annex was responsible for arranging the speaking engagements and the platform that led to his massive success. Instead of paying the Learning Annex, which he hired, he filed for bankruptcy and never paid them. According to court papers obtained by the Post, Kiyosaki, who published the Rich Dad book in 1994, never paid Annex its rightful share. Said the founder and chairman, Bill Zanker, Oprah believed in him. Will Smith believed in him, but he didn't keep his promises to us. This was his call for a crash back in 2017. What happened in 2017? Market did nothing but go higher. He gave some frivolous excuse about baby boomers still need to start drawing money in 2017. They hold $10 trillion in tax-deferred savings, according to Bank of America. Put up this crappy chart here. You can read the article. There's the link. It was nonsense. He does this literally twice a year. It's just his biannual market crash call. It's a matter of eventuality. Are we going to crash back-to-back years? Really? Seems far-fetched. And look, crash call here. You get small corrections. Crash call. Of course, when the market is swooning, people love to make these crash calls. The market's swooning right now. And here he is with crash calls. Market goes higher over time. 2018, we had a 20% correction. Market quickly rebound. Yeah, when we already were in a bear market, this was actually after the bear market in 2020. He said, it's this only the beginning. Of course, he was completely wrong. The market ran 100+%. Just be careful with who you're taking, advice from. It's the end of September. It doesn't look like, this fund strat potential for the market returns in September is going to come true. Remember, the market is up in the first half of the year more than 13%. September actually has a pretty good positivity rate with a pretty good return of 1.4%. Well, looks like we're going to fall in the 33% of the times the market's negative in September, despite the market being up more than 13% in the first half of the year. Again, you lean into the probabilities, but every now and then it doesn't work out and you fall into that other side of the equation. All right. This chart right here, sentiment from the sentiment trader. Last week, traders became pessimistic about prospects for the world's most important ETF, the SPDR, SPY. Then suddenly they calmed down. Dropped all the way down here. We rose all the way back up here. Early in the week, our optimism index for the S&P 500 fell to a pessimistic level below 10, and then it surged to above 50. Forward S&P 500 returns 1 month later, percent positive 80% of the time. 2.2% 1 month return. 2 months later, still good positivity rate, even better returns. Out 1 year, things are looking good. Again, this helps with, holding reasonable expectations. This is definitely consumer behavior, sentiment. But when we don't get, the historical probabilities, when they don't align with the greatest probable outcome, there's usually something going on. And right now could be that usually something going on period, right? We didn't live up to, the September returns based on a very strong first half of the year. Have we ever had this kind of issue at the ports? Not really, folks. Not really. So there are some force factors in the macro fundamental picture that could weigh on some of these historical data studies. Got to keep an open mind, remain flexible. This is still a buy the dip environment, folks. High yield credit spreads are telling you, whatever the market is upset about, whatever adjustments, whatever the market is pricing in, it is not harming credit spreads. They are still extremely tight, folks. When credit spreads blow out, when they widen like they were here, like they are here, then there's something you got to, really recognize in the economic data and in the earnings trend, that may be deteriorating faster than the credit market would like to see. And it should be reflected in your game plan. Study here, the S&P 500 is down roughly 3.5% in the month of September, far above the average September drawdown of roughly 0.9%. That goes back to 1950. We also had a new all-time high, but we're flirting with a negative 3.5%. So when that happens, you have a new all-time high in the month, but then the monthly drawdown is 3% or worse, right? Should we expect for the market to continue, with lower returns going forward, negative returns going forward, right? It seems like there's something wrong there. If you hit a new all-time high in the month, then you're finishing down more than 3% on the month. Actually, the 1 month return, given that criterion, is 1.5% return. 65% positivity rate. 2-month return, 75%. Almost a 4% return. So you're gaining almost everything that you lost back in that month that you drew lower. Gets even better, 90% return 3 months out, folks. Basically takes us to the end of the year. And that's a 5.6% return. There is a lot of white. There's very little red, folks. Very little red. 21 times this has happened. It's not like this is a very small sample size. And I'm sure, here's 2000, folks. Here's 2007. 1997, 99. I mean, we were talking about inflation during the dot-com era, boom, hyperbolic markets. We're talking about the same thing today. There's nothing wrong with the demand in the economy. There's a supply side issue. But this tells us we should remain open-minded, flexible, and cautiously optimistic about better than expected average returns, at least over the next 3 months. Definitely 12 months later. I find studies like this helpful. Tune out all the bearish noise and simply stick to good long-term investing plans. Buy good stocks. If the market goes down, buy good stocks, good companies that you know are going to be able to weather the storm. 6-quarter S&P 500 index win streaks. This is from LPL Financial, right? I mean, even though we're going to end this month on a down note, we're still positive for the quarter, for the Q3 period. So this will be the 6th quarter in a row the S&P 500 is positive. Doesn't happen very often, folks. But when it does, the forward returns 1 quarter later, so this will be the 4th quarter, 3.6% average return. The market is up 85% of the time. 2 quarters later, which takes us through Q1 of next year, the market has never been red. Average return, 7.9%. October, it's not that bad. It's volatility that gets people confused during the month of October. And even that is really just centered on 3 years, 1929, 1987, and 2008. The returns are actually pretty darn good. Over the last 10 years, October returns are among the best monthly returns of the year. So bear in mind, here's the volatility I speak of. 2001 to 2020, look at this. Starts out pretty good, gets even better, but you get a lot of, these are the calendar days or trading days in the month. There's a lot of up and down. This is a bigger down on the 17th, 18th trading day of the October month on average going back to 2001. It's the volatility that confuses people with, the actual strong returns for the month of October. A couple more things. Look, I've talked about the ports. I've talked about wage inflation, supply issues. The earnings are not coming in as expected with some of the few companies that have trickled out already, but they're not tech companies. And that's where the largest composition of S&P 500 earnings come from. But there are good things happening. Look at the 7-day average of positive COVID-19 cases is rolling over pretty hard, 33% off of the high from last week. So good things are happening there. Also, a vaccine may be approved for children under the age of 12 by the end of October. Look, there are parents that are homeschooling because they don't want their kids to, basically be in public school or even private school for fear that they may catch COVID. And that mom or dad who is homeschooling their child is also not able to go to work. There is a working age population right now that just isn't able to go back to work because their kids may be susceptible in a public or private school setting to COVID. But by the end of this month, we may get the vaccine approved from the FDA, the Pfizer vaccine for kids under the age of 12. Also, last month or July, we saw issues because of the rampant infection rate from the Delta variant We saw, dining out go down. We saw air traffic, travel go down. We're seeing that turn up now again. We're seeing it turn up here in September. Bank of America card spending data suggests that the curtailment in the infection data is lending well to a pickup in air travel and dining out once again. Total card spending as measured by Bank of America aggregated credit card and debit card data increased 19.8% over a 2-year period and 16.7% over a 1-year for the 7 days ending September 25th. There's nothing wrong with demand here in the United States. We have a supply issue. The market's not the economy, unfortunately, in this case, right? Because companies don't have enough supply to meet that demand. They're going to have lower sales. They're going to have lower earnings. We'll see. We've got, still 2 more weeks until the kickoff of earnings season with the banks on October 13th with JP Morgan. For now, I think you adjust your game plan. Expect volatility between now and then. There's still uncertainty. We're getting some resolution on the debt ceiling. We're still wrangling over the human care package and the infrastructure package. But quite frankly, the longer we wrangle over those issues, the further we're pushing out any potential tax hikes. Keep that in mind. Everything in the market is kind of a push and pull. With that, I'm Seth Golden. This is our weekly State of the Market. Trade safely, everybody.